Hello and welcome to BQ Prime. You're joining us on this special broadcast. We're bringing you from Morgan Stanley India Investor Forum. I'm joined with Sumeet Kariwala, who is Executive Director at Morgan Stanley India. Sumit, welcome. Your notes, let me just tell you that they've been some of the most fascinating pieces on how the banking system is evolving in India. And for me, that is something that I look forward to quite a bit. I want to start with some commentary with regard to what is currently looking in terms of the outlook on the banking system. What do you see as possibly potential growth triggers as far as you're concerned?
Yeah. Thanks, Vishwanath, for having me on the show. I think so. The banking system is on a very strong uptrend. What we're going to see over the next 2, 3 quarters, and I understand where investors are coming from, is some moderation in margins, some moderation in loan growth, etc. But I think so that's something which might happen over 2, 3 quarters. If I think about the banking sector from a 2, 3 year perspective, the outcomes are going to be very, very, very different. Let me answer this in two parts. First is on growth. Last year, same time, we had very strong loan growth because of inflation, some pickup in working capital demand, some demand shifting from the bond markets to the banking sector, and so on. Possible that some of that demand may normalize, and therefore there could be some moderation. But when I look at retail segment, despite the sharp rise in interest rates, if I look at the disbursement levels, they've not slowed that much. They're still running very strong, and we are almost peaking out on rates. SME, the largest bank in the country, is talking about growing SME in early 20s. So you're seeing very strong risk appetite opening up, very strong demand, which is why retail SME is going to surprise on the upside. My view is that the industry estimate of 12 to 13% loan growth has upside risk. On margins, yes, margins will moderate. But what we need to understand that this is a very different cycle for banks, where a lot of loans got repriced faster than the deposit. And this is the first time that the Indian banking sector is seeing this. Will margins moderate? Yes. The question that I would want to ask is that will margins, after moderating, remain at levels that are higher than history? My calculations say that they'll be meaningfully higher than history, and until the macro situation deteriorates. If that's going to be the case, the profitability is going to be above average. Valuations are still at average levels. So from a 2, 3 year perspective, we are very, very excited on the sector.
So coming to the loan growth side of the story, I'm going to tackle that first, then get on to the other parts of the business. But as far as loan growth is concerned, you said retail and MSME is going to surprise on the positive side. I'm trying to figure out where the wholesale piece fits in, because after a very long time, you've seen some corporates at least come back to the banking sector, trying to borrow money from them. But it's still limited to a very sort of cream of the crop kind of corporates. What does wholesale look like?
Yeah, let's divide wholesale into two parts. There's one working capital demand, which has already gone up. I think so. The economic activity levels will remain strong, and to that extent, working capital demand will continue to chug along. But you may not see the delta that you see last year, okay, which was the economic activity kind of normalized from COVID. The second part is obviously corporate capex. Now, what's happening over there is that the government bit is shaping up really well. There's quite a bit of corporate capex that is happening on the government side. On the private corporate capex, you still have some time to go. If I look at the level of capex announcements that we've seen by various corporates, it has gone up quite meaningfully over the last 1 year. There's some delay in implementation because maybe some entrepreneurs are worried about elections, so they're worried about geopolitical developments. They may be worried about interest rates, demand, etc. But this is something which is going to subside in the next 6, 9 months. If I look at capacity utilization levels, the bank's balance sheet, the corporate balance sheet, over a 1, 2 year period, we cannot not have a capex cycle. It's very tough to imagine. So when people are talking about 12, 13% credit growth, my point is that just expand your horizon to 1 to 2 years. This ought to happen. As this happens, credit growth will be running at 16, 17% in 2 years' time, which is going to be, and I don't think so any analyst or any consensus analyst estimates are baking this in right now.
So what is your upside limit looking like? So not 13%, but then 16%.
So we are projecting around 15 to 16% credit
Okay.
growth over the next 2 years.
Okay, fair enough. And a lot of it is going to come from retail and MSME, of
Yeah.
course, and wholesale is also going to pitch in a little bit.
Wholesale gets in more deeper in fiscal 25 and so on.
Got it.
Because even the corporates put on the capex
Yeah.
and they start to take disbursements,
Yeah.
it's a process. Not
Yeah.
all the disbursements happen at
Yeah.
once, right?
So let me come to the liabilities front, because that is a question that has been sort of on everybody's mind as far as the banking system is concerned. Loans are growing great, but you've got about a 500 basis point gap between loan growth as well as deposit growth. This liability issue, is that really a serious problem, or do you think that this is a little overblown with the current liquidity scenario?
Yeah, I think what happens is that you should look at some of these numbers on a trailing 2-year, 3-year basis because of COVID. So first of all, fiscal 21 and 22, when we were going through COVID,
Yeah.
the loan growth was much lower than deposit growth.
Yeah.
So when you started fiscal 23, most of these banks were sitting on excess liquidity.
Right.
Now, banks were like, if you're sitting on excess liquidity, why do we accelerate growth? Why do we pay up on deposits? And why should we not utilize the excess liquidity
Yeah.
first? So if you look at the term deposits, the term deposit rates for banks went up meaningfully around September, October last year. Before that, despite RBI raising rates, banks didn't raise deposit rates. So what the way to look at deposit growth will be what has happened over the last 2 years, last 2 quarters on term deposits. Last 2 quarters, term deposits is growing at 20 to 30% for the stronger banks. This, even if it normalizes on a higher base, should be 15 to 17% in fiscal 24. The other part of term deposits, the residual part, is CASA. Now, CASA always slows in the first year of interest rate hikes. That is because banks will be sitting on excess liquidity and that will move out from current accounts. On savings, this time we had slightly different event because we had COVID for 2 years, people didn't spend, and therefore the savings deposit growth did very well. Now, both of those things have normalized as of March 23. CASA growth should be better in fiscal 24 than fiscal 23, which is why if I just combine these two, I don't see why banks can't grow at 13, 14%. In fact, some of the stronger banks say should be reporting 17, 18% deposit growth this year.
I mean, at least one of the large private guys, the top of the pile, did report about 20%. Having said that, I want to tackle this question from a system-wide basis. Yes, some of the larger players, 70, 18%, sure. What happens to the end of the pack? Is that going to always be tight on liquidity, tight on the liabilities front? Is that going to continue?
So if you look at what has happened in Indian banks over the last 10, 15 years, is that there's a growth differential between the stronger banks and the weaker banks. And the set of stronger banks has changed, the set of weaker banks have changed. So even when I'm talking about system loan growth of, say, 14, 15%, or system deposit growth of 13, 14%, there'll be some banks which will grow at 17, 18%, some banks will grow at 11, 12% on loans. So even the deposit growth will diverge. There'll be some banks which are not that strong, which will grow deposits at 10, 12%. They will be losing they've been losing market share, and they might lose market share, continue to lose market share. See, deposit growth is a function of a number of things: your distribution, your brand, and now your tech capabilities, and so on. There are differentiation between banks in India on these metrics, and to that extent, some banks will outperform.
Great. Coming to the margin question now, you said that margins will sort of moderate, at least in the coming year, and then things will normalize as they usually do. But how much is left in terms of the deposit rate repricing, which will affect this margin? How much of that period do you see coming up?
Yeah, so I think the bulk of the deposit repricing or the lead lag that we've seen at Indian banks will be done in 4 quarters from now. So depending on the bank you're talking about, the term deposit cost increase that I expect for banks will range from, say, 40 to 80 basis points. It'll be somewhat higher for the wholesale funded banks because their deposits reprice upfront, higher for the retail funded banks because they raise deposit rates at a later stage. Now, if you think about margins in this context, the potential for loan yield increase will be, say, 20 to 40 basis points, depending on the bank we're talking about. Bulk of this is going to come from the MCLR increase. The repo rate increase is already done. So if you just try to say 20 to 40 basis points of loan yield increase, 40 to 80 basis points of cost increase, you'll see margin contraction of 30 to 40 basis points, depending end to end. But if you'll try to think about the exit margin, even after doing this math, because margins have gone up sharply over the last 1 year, you will still be at levels which are better than what we've seen for many years.
What does that mean for profitability? How obviously we've seen one FY23 of pretty strong profitability, even on the public sector side of the story. But going ahead, what is going to drive that?
Yeah, so let me take a step back. If I look at last 3 years and the improvement in profitability, and if I were to just simplify it to two factors, one is basically the margin improvement that we spoke about. The other is a substantial reduction in credit cost.
Right.
So if I look at the state-owned banks, they were running with provisioning to assets, net of recoveries at 1%, say 3 years back. That has come down to 0.2%. Now, what is going to happen over the next 2-3 years is that both margins and credit costs will normalize. Credit costs may continue at 0.2, 0.3% net of recoveries for 1 or 2 more years, but it has to normalize.
Yeah.
So what you will see is that at the stronger banks, the profitability stays slightly above average levels as long as the cycle is good. At the less stronger banks, where a lot of profitability is just driven by improvement in credit cost and not that much by margin, for them it'll normalize faster.
Okay. Coming to the balance sheet question, I want to understand. So, after a very long time, the Indian banking system is sitting on record low NPAs. We've got great capital adequacy. This lowering of risk or this absence of risk, does that pose a risk in itself? Because people tend to get a little more carried away with the growth trends then.
Completely agree. And as is always said, that the seeds of the bad loans are sown in good times.
Correct.
So you do have competitive intensity pickup. And I think that the competitive intensity pickup works in two legs. First, people start to compete on pricing when times are good. Then people shift that onto underwriting.
Yeah.
What we are seeing right now, and because we've gone through a 15-year bad credit cycle in a lot of banks, you're seeing that the competitive intensity is largely on pricing. People are not moving down to a level where they start to compete on underwriting. Okay, so we're not seeing those trends so far. But would I want to make a comment that next 2 years is not going to happen? Not really. There'll be players who might have to go down the quality curve, or who may choose to go down the quality curve, and then they'll go through cycles.
Yeah.
The point is that I think so where the surprise may come from is that the cycle may be a lot longer than what people expect. See,
You're referring to the
growth cycle, and which is why the credit cycle. See, what has happened over the last 5 years is that the amount of data that you have that is now available on a lot of customers has gone up quite meaningfully. So you divide customers into 3 parts: great, okay, bad. A lot of okay customers, which were rated okay, have shifted to great because now you have more data on them and more comfort on underwriting them. To that extent, okay, the opportunity set has gone up, and maybe the cycle continues for longer. That could be the positive surprise.
In terms of the downside risk, because there is a global recession that we're witnessing, or at least are hoping to see it. Not hoping actually, but possibly we will see. And how much of that plays into the India story then?
Yeah, so it's a very interesting question. I'll tell you what has happened in India over the last 10, 12 years. Because we were going through a crisis in one way or the other on an underlying basis. If there was something untoward happened globally, India used to face the repercussion in terms of trade, maybe some impact on jobs, etc. And then we went in a 2-year bad cycle, right? In the sense, we'll first assess the impact, then recognize the bad loans, then make the provisioning, then the risk appetite will come back. So it took like 1-2 years to come out of this. You look at what's happening at Indian banks over the last 1.5 years. You saw Russia-Ukraine crisis. You saw crude oil prices moving up. People worried about NPL. People worried about consumer demand, etc., etc. We had some issues for 2-3 months, but then we came back very quickly. Same thing happened, say, when you saw some of the crises happening in the global world. You didn't see the risk appetite in Indian banks change quite a bit. Why? Because we are having a very, very different balance sheet now. The balance sheet is seasoned, completely de-risked. Okay, and the underwriting practices have been tightened. There are a lot more opportunities that we have now, unlike history, because of tech. So if I combine all these factors, my view is that even if there's a problem globally, this recovery cycle will get delayed by, say, 1 or 2 quarters max. But we are not giving away this story.
Okay. So not ceding space as such.
Yeah.
Got that. I want to touch a little bit on this topic of private versus public sector banks. Now, obviously, for a prolonged period of time, we have seen private banks outperforming public sector banks greatly on various
Yeah.
metrics. PSU guys are improving. Their profitability is definitely improved. Loan growth is again looking good. Capital adequacy is looking strong. Uh, where does this sort of comparison lie at this stage in FY24 as we're getting into the
Yeah.
year?
Yes, so I think so. The state-owned banks have done very well over the last 2 years, and they've improved on profitability, and they have normalized on valuations. Now, incrementally, the way in which you think about banks' outperformance from here on is that last 2 years were all about asset quality, all about who had better liabilities. Incrementally, this is going to be about growth. Who can outperform on revenue growth? Who can gain market share? Who can cushion the margin downfall? Who can have margins which are above normalized levels over the next 2 3 years, and so on. So every bank will have to be evaluated on that aspect. I think that there'll be some stronger state-owned banks which can deliver this, and they'll continue to outperform. There would be some weaker state-owned banks which may not be able to uh, uh, do well, and therefore they will not be able to re-rate any further. One of the aspect which is also going to matter from a state-owned bank perspective is ECL, which is basically a shift in the credit cost provisioning regime from, say, to expected loss. Now, if a number of state-owned banks will have to provision based on their credit history, track record, stock of provisioning, etc., etc. And there'll be some banks across state-owned banks and private banks which will be more impacted. That is going to also put some differentiation in terms of how stocks rate it.
Coming to the picks part of the story, because obviously every time you talk to an equity analyst, you have to ask them. But what do you think are the best picks for investors when they're looking at the current?
Yeah. So we obviously can't comment on stocks, but what I would leave you with is that we've been very constructive on large banks and large private banks within that. I think so. The last cycle, if I look at last 10 years, you had a lot of mid-sized banks do well. Like if I look at mid-sized banks as a basket, they did very well. Because what was happening is that if I look at 3 or 4 of the large banks, in fact, 3 of the large banks, they were going through a credit cycle. To that extent, not that they were not competitive, but they were focused on resolving asset quality issues. They were fixing some of the underwriting practices and so on. If I look at post-COVID, those banks have emerged really, really strong. You look at funding, they have a very differentiated advantage. Look at balance sheet, both capital and the excess provisioning that they have, which they created during COVID, is actually levels apart. The amount of investments that they've done in tech is very, very strong. And what will happen is that over a 3 to 5 year period, as more and more loans are sourced digitally, as they increase the cross-sell ratios, as the productivity ratio improves, the cost to income ratio outperformance that some of these banks have, as opposed to the sector, can be quite meaningful. So they've now become very sustainable compounding stories with upside risk if the technology benefits really play out. So that is one theme within the banking sector that we've been pushing a lot.
How far do you think this tech play is going to play out actually?
So I think there's a lot of upside over here. To an extent, some of the upside will be competed away, passed on to customers. There are some regulatory changes which have happened, and that could put some pressure on revenues and so on. But I'll relate this to what's happening globally at some of the banks who are facing challenges in some of the countries. They're not able to grow revenues, and to that extent, they're not able to invest in cost. Or the fintechs are trying to compete with them very aggressively, and they're gaining share at a very fast pace. What's happening in India is that banks and fintechs are collaborating, and some of these banks can actually outperform on growth and profitability relative to the rest of the world. They can therefore not derate, and in fact surprise on earnings over the medium term.
All right. Thank you so much for joining us on this conversation.
Thanks, Vishwanath.